All right, welcome to The Explainer. Today, we are digging into a massive shift in how credit decisions get made. We're talking about moving way beyond ESG as some kind of reputational bonus and into its new reality as a core piece of financial risk.
Okay, let's get right to it. If you're in the C-suite or really anyone dealing with serious borrowing, this question right here, it's not some abstract, theoretical idea. How you answer it over these next 24 months will literally determine whether you can get the capital you need.
And look, I want to be crystal clear about this. If your company still thinks ESG is just for the marketing department, for the glossy annual report, you are completely missing the boat on what actually gets you access to capital now. This has become a hard-edged financial reality. So you might be wondering, how in the world did we get here? Well, let's unpack this huge shift in how lenders are thinking. This isn't about values anymore. It's all about valuation and, you guessed it, risk.
What we're seeing is this incredible shift. It's like going from getting a little gold star on your homework to needing that homework just to pass the class. A few years back, a good ESG score, maybe it shaved a few basis points off your loan. Now, a bad one could mean the credit committee won't even look at your application.
And this isn't just some passing trend, something driven by what investors feel is right. Nope. This is being locked into place by some serious regulatory muscle, especially coming out of Europe.
What this timeline really shows is that the clock is ticking, and it's ticking fast. By January 2026, those guidelines from the European Banking Authority, they go from being a friendly suggestion to a hard and fast rule. What that means is banks are going to have to show their work to regulators. They'll have to prove exactly how your ESG profile fits into their risk models. The softly approach, that's officially over.
Okay, this is a super important distinction to make. We are not talking about the ESG story you tell the public. We are laser focused on what we're calling credit ESG. These are the specific hard numbers that lenders plug into their spreadsheets to predict if you're a good bet or not. This is the language spoken behind the closed doors of the credit committee. All right, so let's get into the nitty-gritty. How exactly are lenders looking at your business now? What you'll see is they're basically taking E, S, and G, pulling them apart, and then putting them back together as direct financial risks. First up, the E for environmental. And let me tell you, lenders are so over those vague, far-off promises like, oh, we'll be net zero by 2050. They want to see the receipts. They're looking for real, concrete transition plans backed by actual capital spending. They're asking some really tough, tangible questions. Is that big real estate portfolio you own going to be impossible to refinance in 5 years because of bad energy ratings? Are your factories sitting in what's about to become a flood zone? These are direct hits to your cash flow and ultimately your ability to pay back the loan. Next, the S for social. And in the world of credit, this has nothing to do with corporate values and everything to do with keeping the lights on. A social failure is basically an operational failure just waiting in the wings. And here's the key thing to get. These social issues are now being plugged directly into operational risk models. A labor issue in your supply chain, even if it's 3 steps removed from you, could legally shut down your production line. And a big lawsuit? Well, from the bank's perspective, that's a direct threat to them getting their money back first. And that brings us to the G, governance. Honestly, for any credit officer, this might just be the most important piece of the puzzle. Think of it as the foundation that everything else is built on. It shows how well you manage all the other risks. At the end of the day, if your governance looks weak, lenders see a management team that just doesn't have a firm grip on the wheel. And trust me on this, if your ESG data is sloppy, a lender is absolutely going to wonder if your financial data is sloppy too. Okay, so what does this actually look like when the rubber meets the road? This isn't just theory. Let's walk through a few real-world credit scenarios that are already happening as banks gear up for 2026. So check this out. Our first case is a portfolio of prime commercial real estate. They go to get a 10-year loan, and they get denied. Why? The energy ratings were terrible. The lender's rationale was brutal. They basically said the asset would be impossible to rent out or sell by 2030. They called it a stranded asset and would only offer a super expensive, short-term loan just to fix the problem. Case number 2. A manufacturer misses a deadline to provide their verified ESG data. Now, this wasn't like forgetting to file a minor report. No, it actually triggered a technical default clause in their loan agreement. That gave the lender the power to call the entire loan and force a renegotiation on much, much tougher terms. And for our third story,
Get this. A family office goes out to finance a new venture and finds that 40%, nearly half, of the banks they normally work with wouldn't even take their call. Why? The new business just didn't check the right green boxes for the bank's own portfolios. And you know what happens when there's less competition, right? The lenders who were left demanded returns you'd normally see on an equity deal, not a loan.
So when you're staring down risks like these, the goal has to be to stop playing defense. You have to shift from a check-the-box compliance mindset to a truly strategic one. This is all about proactively managing your access to capital.
If you take one thing away from this, let it be this. Data quality is the new collateral. It's that important. See, if you can't provide high-quality, verifiable data, lenders have no choice but to assume the absolute worst-case scenario in their risk models. And that data gap, it will always mean you pay more for capital or you get a worse credit rating. Period.
So this four-step plan isn't just about keeping the regulators happy. It's a straight-up capital preservation strategy. You need to audit your ESG data with the same rigor you apply to your financial statements. Make sure your transition plan is a real financial roadmap, not just a pretty marketing document. And for goodness sake, start talking to your lenders now about what they're going to expect. The bottom line is just so simple, but so critical. Your ESG data has to be as rock solid and defensible as your profit and loss statement. It has to be able to stand up to the exact same tough scrutiny. So to wrap this all up, ESG isn't about earning a badge for being a good corporate citizen anymore. Now it's the gatekeeper. It's about proving your entire business model is tough enough and investable enough for what's coming. It's the ticket you need just to get in the door. And that leaves us with the one question every business leader absolutely has to be asking themselves right now. Those who get ahead of this, who treat credit, ESG, with the strategic seriousness it deserves, they're going to have a massive competitive advantage when it comes to getting capital. And those who don't, well, they're going to find that the capital markets are a much colder and much more expensive place to be.